Good morning, everyone. Welcome to the 19th annual. That's good. Let's have one more time. Good morning, everyone. There we go. We'll get it warmed up. I want to welcome you to the 19th annual Intergenerational Estate Planning Conference. We are here kind of at the precipice of a new dawn, and that is a red dawn. And we're going to talk about some of the changes we're anticipating. We're going to talk about some of the tax law, economic changes, but we're going to talk also about some fundamentals. And we hope to have a calming influence by the time you leave, because I know I'm not, but the fundamentals still apply. And for our clients, we need to keep our eye on that ball and make sure that we're working with our clients in a way that we don't take a short-sighted view and say, well, this is going to be the reality forever. It wasn't the reality a month ago, and it won't be the reality 10 years from now. So let's talk about long-range planning, and we're going to look at how we can bring that to the forefront for our clients. Pierre O'Connor and Strauss is your host for today, along with all of the speakers and sponsors that you see. We're a trust and estates, elder law, and business succession planning firm. We have an office here in Manhattan at 260 Madison Avenue. Our home office is in Albany. And we have some members here from the firm, and as I say their names, if they would stand up: Burley Brown, Tom Marasco, they're in our New York City office; Arkley Mastro, who is in our Albany office; and my inimitable partner, Peter Strauss. Peter, many of you know Peter, so he has been with us now for about, I think, 7 years. At the part of his career, that's the last 7 of 62. So we're happy to have him with us. That just tells you how long he's been practicing. Jessica, who greeted you on the way in, is part of our team. She's there in the doorway. And as always, I want to thank our marketing staff, because this program, as you might imagine, is a very heavy lift. And it's something that we're very proud of, the 19th annual, and that is Beth Wertman and Tim Flynn. Nice round of applause for Beth and Tim. The slides have a tremendous amount of content. We did not print them for you. We're saving trees, but you can find them at pirolaw.com events. So you can download the slides. You can find all the materials there. There is a Wi-Fi. It is NYC bar-GN, and it's ABCNY Center. So that is your Wi-Fi. If you want to log in, you can get the materials. You can follow along on the slides if you brought your laptop or on your phone. And also for you CPAs, we have CPE. So from the firm of Farku, Furman, and Faccio, we want to thank them for sponsoring the continuing education credits, and make sure that you fill out the proper paperwork to claim your credits at the end. And each year we do a survey at the end of the program, and we collect that. It is a blue form. It is in your materials along with the program. The program does have the outline for today, the agenda. It also has speaker biographies. So I'm going to keep the bios brief in the introductions. You can research on your own in the program who our speakers are. These are our sponsors, and we want to thank them for making today possible. They help us defray the costs of this program. Farku, Furman, and Faccio, as I mentioned; Empire Valuation Consultants, who gets a special shout out; Nathan Schroeder. They have been here for 19 years. They were one of our original sponsors 19 years ago. And Stern Slavutin, Lee Slavutin, who's going to be our insurance speaker; PPAC Private, Ray Radigan, who has been here as a speaker before, but first time with PPAC. And we're very happy to welcome Doyle Galleries for the first time to add a little bit of color and fine art to our presentation. And we'll have those right after lunch. These are the speakers. We'll take them one at a time, but this is where we are. We've had a red wave. It took 2 years to crash to the shore. 2 years ago, we were told the red wave is coming and they were going to sweep the 22 elections. Well, they swept the 24 elections. Just took a little bit of time. And now we have a House just declared yesterday to be Republican. We have the Senate Republican. We have the President Republican. We have a Republican Supreme Court. And we have very few guardrails now on the legislation that will be going through and the executive orders that will be coming through. Unprecedented control, not because they have all three, President, House, and Senate, but because the party is controlled really by one person. And that's a first in our history. So we have to see how this plays out. We're going to talk a lot about that. One fact I want to give you before I turn it over to Hugh Johnson, and that is the debt $36 trillion. The deficit, $1.9 trillion. And the next item, which is to me the most frightening and what I hope our legislators focus on at some point, that is the interest on the national debt. In 2024, the interest payment was $1.16 trillion. Interest on the national debt. The projections for the tax cuts that are proposed is $4.6 trillion added to that debt. So just keep compounding the interest payments that we have, and we see that the sustainability of discretionary spending, the debt payment is as high as anything except Social Security and Medicare. It's more than defense spending. So that's where we are from an economic macro perspective from the debt. Now let's look at the economic forecast, and we're very fortunate today to have with us someone who is nationally recognized as an economist. He appears regularly on CNBC, Bloomberg TV, other networks, appears in the Wall Street Journal. He is the chairman of Hugh Johnson Economics and the chairman emeritus for Gray Point, which is a capital management firm. They were one of our speakers on Wednesday in Albany, New York. I've known Hugh for a long time based upon his career at First Albany Corporation, which was a company that I worked with 30 years ago that no longer is around. But Hugh is going to bring us his unique insights and perspectives on the economics going forward. Hugh.
Sure. Can you hear me? Can everybody hear me? I professionally, I do a lot of economics and economic forecasting, call it guessing. Call it strategically sound guessing. Nobody has all the answers. But I also, in my career, the best part of my career, the most enjoyable part of my career, quite frankly, was teaching. I was a professor at RPI and also a professor at Union, which became Clarkson. And one of my things I enjoyed the most, quite frankly, was being in a classroom and talking to students and going through the process of learning, especially the students learning and me sharing that learning experience with them. I learned from that, and you'll see I'll start to walk around because that's just kind of the way I feel comfortable. And since I'll be talking away, and I'm going to be talking about, this is, a lot of stuff is going on, and it's going on very fast. And some of what I'm going to be talking about gets a little bit complex. I apologize for that in advance, but I also encourage you to raise your hands, interrupt me, throw something at me, do anything you can, and I'll try to stop and answer the questions so that there's continuity in what I say. But this is not easy stuff. And my goal, if there is a goal at all, is for us all to come away with a little bit of a better understanding of first of all, what's the sort of a baseline forecast for what I think lies ahead for 2025 and 26. And then most importantly, I'll try to wade through what I think the implications are of the Trump policies on that baseline forecast. And as you can imagine, it's very hard, first of all, to know what those policies are. They've been all over the place. But I think we're getting a pretty good idea, particularly given some of his appointments to his cabinet, as to what might lie ahead. It's in an uncertain time. At any rate, it's nice to be here. It's nice to have you here. And again, don't be reluctant or shy to ask questions or raise your hand. And then again, as I say, throw something at me as long as it's not a guided missile or something like that. So please feel free to do that. I had a good friend of mine, Walter Goldstein. I don't think anybody here probably knew Walter. God rest his soul. Walter was a professor of economics at SUNY, and Walter used to introduce me quite regularly to make speeches of this sort. And he used to say, well, Hugh ordinarily tells a joke and then gives a forecast. And he said the problem is it's sometimes difficult to tell which is the joke and which is the forecast. I will not tell you a joke, but I will tell you a true story. And the reason I'm going to tell you this true story is it allows me to sort of drop a name. And in 1987, when Alan Greenspan was selected to take over for Paul Volcker as chairman of the Federal Reserve, USA Today called me and asked me, well, what do you think? And I said, well, Alan Greenspan is certainly an able economist, which he was, an able economist, but he lacks Paul Volcker's depth of understanding of the Federal Reserve System. That's not a particularly profound statement because Paul Volcker had essentially been brought up in the Federal Reserve. Well, the next day on the front page of USA Today, not the money section, the front page of the newspaper, it said, Hugh Johnson says Alan Greenspan lacks Paul Volcker's depth, period. That was not particularly good. About a week later, I was having lunch with Bill Seidman. Some of you may remember Bill Seidman was chairman of the FDIC, and I looked at Bill and I said, you don't suppose Alan Greenspan reads something as trashy as USA Today, do you? He said, oh yeah, he reads that, he reads everything, he never met things. So I went back to my office and I wrote a letter to Greenspan and said, it's taken out of context, here's what I did say, here's what I meant to say, here's what I would hope would be printed, and I wish you best of luck as chairman of the Federal Reserve. And he wrote a handwritten note to me, and I got it 2 days later, a handwritten note, and it said, thanks for giving me telling me about the alleged quote and bringing it to my attention. I actually didn't see it. At any rate, so we've been very close friends ever since, I'm sure. Let me have the clicker change. And sometimes I get to make a mess of this. I don't know why I did this. Yeah, I do know why I did this. These are my grandsons. And I give a speech up in Albany every year, and for some reason or other, it's an awful thing when you're a grandfather and you show pictures of your grandchildren. And I don't know why I couldn't resist it. But I really had a message for you, a message for some of you. And the message was this. As you can see, they're lacrosse players. And they're now graduating from high school. And they became such incredible lacrosse players. One of them got into Dartmouth, and Dartmouth doesn't give them a scholarship because scholarships are not allowed. But the other one got into Connecticut College, and they gave him $100,000 to go to play lacrosse at Connecticut College. I'm giving you this with some advice for those of you that are more senior, and that is if you have some grandchildren, or even if you're not that senior and you're going to have children, start them young and put them into lacrosse players, and you'll be able to avoid those high, needless to say, those high charges for tuition and things like that. That's the only reason I did it. I said maybe there's a lesson in this. I have been studying cycles. I've been studying cycles, and again, ask questions if you don't get this stuff or if I go too fast. I've been studying cycles, all the cycles since really 1890. And since 1890, there's been 25 cycles which have a stock market cycle, an economic cycle, and an interest rate, inflation and interest rate cycle. And I've been studying them since 1890, and they all play out fairly much the same. And as you can see, there's a bull market. Bull markets, there have been 25 bull markets. They've lasted 47.6 months on average and gone 142.5%. And then you take a look at the current bull market, 140.4% over 56 months. You can see it's about average. And so this one's about average, and it raises the question, the very important question is, okay, what's next? We're now at the average. The next thing we're gonna see is a bear market that's accompanied by an economic recession, or is the current bull market gonna continue? That's a really important question. We're gonna try to answer that question today. We have along the way, incidentally, bear markets, which are 10% declines in stock prices accompanied by a recession, or sometimes you get just simply straightforward corrections in stock prices, which are not accompanied by an economic recession. we've had one big one in the current cycle. But nevertheless, the real question is, are we about to have, or can we have, now that we're at average, are we going to have a bear market that's accompanied by an economic recession? I've been trying to figure out a way to answer questions like this all my life. You can see it's been a pretty boring life, and that's what you spend your life doing. But what I've done is I've found that there are essentially two steps in the methodology that I've developed. The first step, which is an important step, is to identify important trends that are unfolding in the financial markets. The reason I do that is because, as I said, there are 25 cycles that we've seen, and those cycles consist of a stock market cycle, followed by an economic cycle, accompanied by an inflation and interest rate cycle. And interestingly enough, the financial markets perform in very specific ways at the beginning, the middle, and the end of those cycles. And so, by identifying where we are, looking at the trends in the financial markets, identifying where we are in the cycle, making those really important decisions like asset allocation, the percentage of your portfolio you want to allocate to equities, or making even good business decisions. Do you want to build your inventory or not build your inventory? If you know where you are in the cycle, if you're at the beginning, the middle, or the end of the cycle, then making those kinds of decisions gets to be a lot easier. Not easy, but easier. So that's the first step in the whole process. We'll go back there. The second step in the process is after you identify the trends in the financial markets, you know what investors collectively are doing or saying, then you try to identify important trends in the important monetary and economic variables. And the basic idea there is to try to decide if the trends in the financial markets are indeed rational. Are investors collectively performing in a way that's consistent with a rational forecast for what lies ahead for the economy and earnings, inflation, and interest rates. Now, keep in mind, most of the time, what we have is what we might call rational. In other words, the financial markets perform in a rational way or in a way that's consistent with a rational forecast for what lies ahead for the economy and earnings. It all fits together often very, very well. The problem is that sometimes the financial markets, the rational performance starts to give way to something that's a little less than rational. In other words, optimism starts to give way to exuberance. And when we talk about this, we're talking about not only gives way to exuberance, whether it could be the S&P 500 of the market as a whole, or it could be a group of stocks such as the Magnificent Seven. I hope you're familiar with what the Magnificent Seven, who they are. That's the artificial intelligence stocks, or even an individual stock like Bitcoin or NVIDIA. In other words, optimism starts to give way to exuberance, which starts to give way to euphoria. We start to move from the first stage, which is the stage of rational investment, and we move into the stage of speculation. And then this stage of speculation, as you can imagine, investors become speculators, and they borrow money to buy assets, individual stocks, at prices that are arguably overvalued, with the hope, the dream, the fantasy that they're going to become even more overvalued. One of my favorite statements of all time comes from John Kenneth Galbraith, the professor of economics at Harvard University. And Galbraith kind of hit it right when he said the circumstances that induce recurrent lapses into financial dementia have not changed in any truly operative fashion since the tulip mania of 1636 and 1637. One of my favorite, in fact, by far my favorite economist, who wrote Manias, Panics, and Crashes. Manias, Panics, and Crashes is incidentally written by Charles Kindleberger. And it is without a doubt in my mind, well, in my mind, the best book that's ever been written on the financial markets. Charles was an economist at MIT, but he preferred to call himself a historian. And if you talk about history, get manias, panics, and crashes, and it takes you through everything from 1630 up to present. It's a little bit tough going, but he was, God rest his soul, wonderful person. One of the things Kindleberger once said is there is nothing so disturbing to one's well-being and judgment as to see a good friend get rich. That leads you into a monkey see, monkey do financial market environment. Keep in mind, there's a sucker born every minute. The defining characteristics of speculation, whether it's Bitcoin or the Magnificent Seven or the S&P 500 itself, the defining characteristics are, first of all, leverage. Remember, investors become speculators and borrow money to buy assets at prices that are overvalued with the hope, dream, and fantasy that they'll become even more overvalued. Optimism starts to give way, again, to exuberance, which gives way to euphoria. The most important characteristic of speculation, this is going to be a part of your lives. Let me tell you, I'm telling you, it's something that's in your life right now. We'll see in just a minute. But it's very important to kind of understand this stuff and how to identify it and deal with it. But at any rate, exuberance and overvaluation, which is so very, very, very important. The stage of speculation gives way in time to the stage of financial distress. How many of you here? Well, this will be a good question. How many of you here have heard of Hyman Minsky or the Minsky moment? Anybody? You'll find if you study this stuff, the Minsky moment is probably one of the more famous contributions of all time from Hyman Minsky, who incidentally was, I'm very proud to tell you, I knew Kindleberger personally and I knew Minsky personally. The Minsky moment was really invented or most created by Charles Kindleberger. And that's when we move from the stage of speculation to financial distress. In the stage of financial distress, the investors that became speculators begin to have difficulty making their debt service payments. Some do not and default, and the lenders, the banks, lenders that finance the speculation begin to get cold feet and start to back away from the markets. And as they back away from the markets, then we move from the stage of financial distress to the stage of revulsion. In the stage of revulsion, there's a veritable race for the exits. I want to give you one word of warning, which these folks have heard me talk about before, and that is, and you really got to think about this, because it will be in your own lives, and I'll bet it's a big part of your lives right now. It's a little hard to understand, and we're just going to mention it, but the urge to swindle and the urge to be swindled, think about that. The urge to swindle and the urge to be swindled runs parallel to the urge to speculate. Bernie Madoff. And you probably know somebody that had this instinct that they shouldn't have been caught up in the speculation with regard to some individual stock or the market itself, but did it anyway, invested anyway. You probably know somebody. And that's exactly what I'm talking about. The urge to swindle and the urge to be swindled. You'd be surprised. The urge to be swindled is very widespread and very permanent. The question, of course, which has come up more recently is, are there any examples today of speculation? And I'm going to show you two where you can at least raise the question. First, of course, is NVIDIA. Now, I apologize, I do own NVIDIA, and I'm happy, but I'm one of these speculators that got caught up in the urge to speculate. But you can see it, that the S&P 500, and looking at the performance of the S&P 500 for 2023 and 24, the S&P 500 up 40.1%. The Magnificent Seven, which are the seven, really call them artificial intelligence stocks, during the same period of time up 138%, and then NVIDIA up 807% in 2023 and 2024. One of my favorites, of course, is Bitcoin. Bitcoin now up, I'm not even sure. It's hard to keep up to date because it's now up, it's a high price, let's just put it that way, 324, up 324.3%. Now these are examples of what I would say certainly are minimally on the edge of being speculative. I worry in particular about the artificial intelligence stocks, and I worry about the artificial intelligence stocks, NVIDIA, and a number of them, especially, you've got 5 companies, really, folks, when you think about it. 5 companies that are spending billions of dollars on chips and energy and getting into this business, and they have very little to show for it. Watch the earnings, sales and earnings of these companies. Not much. And they don't have anything to show for it yet. And you ask yourself the question, why are they doing it? Well, the answer to the question is, I don't know why they're doing it, but the question really is, what you're really asking is, look at the numbers. The adoption of artificial intelligence is really going at you might think it's fast, but it's not. It's at an extraordinarily slow pace. The bottom line, what I'm saying, is that I think there's a payoff from artificial intelligence, but the development or the adoption of artificial intelligence is going to be far slower than anybody in this room really thinks. Goldman Sachs thinks that we might get a 0.1% contribution to productivity gains, but not, 0.1%, not a lot, until 2027, when we start to see it. Let me just say it this way. Artificial intelligence, the adoption of artificial intelligence is going to be linear, not exponential. It's going to take a lot of time. It'll happen, and it'll give us the contributions to 25% of the workforce. It'll give us the contributions to productivity that we really need, and I'll get to that in a minute, but nevertheless, it's going to be a very slow process. So when you ask the question, is NVIDIA, or even Bitcoin, I mean, that's another one we could talk about. Is it speculative? I think the answer is, well, I don't know the answer, but I'll tell you, it looks pretty close to me. It looks pretty important and close. Any questions on that so far? Again, I just went through that pretty quickly. Now what I want to do is, I want to go through the financial market trends, and then I want to go through to see if the trends are very rational. And this is pretty straightforward. First of all, the trends in the equity markets since the bottom of the big correction in the stock market in 2022 is positive. Stock market being up 67.3%. During that period of time, investors have been migrating to the so-called bull market sectors. Bull market sectors have been outperforming bear market sectors. For the sectors of the market which are more economically sensitive, that require an economy which is expanding and producing good earnings, those sectors are doing very well. Investors are telling you that they're optimistic about prospects for the economy and earnings, and so they're buying the economically sensitive sectors of the market and avoiding those safe sectors of the market, things that produce good earnings regardless of what's going on to the economy. Consumer staples, things like household products. Household products produce good earnings no matter what's happened to the economy. You might have some friends that stop brushing their teeth, but I don't have any. And so, yes, staples do continue to do very well. Utilities continue to do well, and it's kind of a special class right now. And it's also the case, of course, that healthcare stocks tend to do very well. They're defensive sectors. Investors are buying the so-called economically sensitive bull market sectors and avoiding the less risky bear market sectors. And again, those are the safer sectors to include, again, utilities, staples, and healthcare stocks. Growth stocks are outperforming value stocks. Growth stocks, which have high price earnings ratios and relatively are very volatile, are outperforming the value stocks with lower price earnings ratios and higher dividend yields. Again, investors are starting to playing it less safe, and they're playing it less safe because they're increasingly more optimistic about prospects for the economy and earnings. Quality spreads, a little bit tough to understand. The quality spreads are the difference between the yield that's paid to somebody that owns a corporate bond and a yield on a 10-year treasury. Those spreads have narrowed. They've narrowed. In other words, investors that own corporate bonds are willing to accept low yields relative to treasuries, and they're willing to do that because they think that those corporate bonds are going to continue to pay the interest and principal on the bonds that they own. They're very optimistic that prospects for the economy are good, and since prospects for the economy are good, they're going to get paid the interest on the corporate bond that they own. So the spreads, the difference between what they're being paid, the yields they're being paid on owning a corporate bond and the yields on owning a treasury have narrowed. It's also the case that that's true of not just investment grade bonds, but also below investment grade bonds, junk bonds. Investors are continuously willing to accept a lower rate of interest on a junk bond than previously, and they're willing to accept that because they're becoming increasingly more optimistic about prospects for the economy. You can see how this is all shaping up. And then finally, this is the one I really like the most. For those of you that are new and a student of this, and I really apologize, this is really, really complex. The yield curve is something we watch very carefully. And the yield curve has been inverted for a long time. And the yield curve being inverted, I'll just tell you, the yield curve being inverted is a bad sign. It's a sign that prospects for the economy are not doing well. But look at the right on this. And you look at the right, the yield curve is about to turn positive. Now, it's from the yield curve that we get the probability or possibility of an economic recession starting in 12 months. And that probability, as calculated by the Federal Reserve Bank in New York, is coming down and down and down. And so the prospects of a probability, let's say, of a recession starting in 12 months is still pretty high, but it's coming down and it's getting less. And it's going to get even more or less, if that's the right way to say it, more or less when next time we get a print on the yield curve. So what we have is the financial markets, stock market's doing well. Investors are migrating to the so-called economically sensitive bull market sectors away from bear market sectors. Yield curves, or the spread between bonds and 10-year treasuries, is narrowed. The yield curve is about to turn positive. The message of the financial markets, the trends in the financial market are clearly positive. And the question is, are those trends rational? Are they consistent with what I take to be a rational forecast for the economy and earnings, inflation, and interest rates? Now I got paper somewhere. Here it is. I like to answer that question by saying there have been two distinct periods in the last 4 or 5 years. There's the 2020 and the 2021 period. We had the 2020 and 21 period when we had some real challenges, the challenge being the pandemic. And in the second quarter of 2020, the U.S. economy contracted at a 28.1% annual rate. And 20 million people lost their jobs in the second quarter of 2020. We haven't had anything close to that in our economic history. The worst number we got on the economy was 10% in 1953. This one was 28.1%, and as I mentioned, 20 million people lost their jobs. There's a significant challenge that occurred, obviously, in the first 2 years, the 2020 to 21 period. That led to another set of challenges during the 2022 to 23 period. And the set of challenges in 22 to 23 were very simple. Inflation, which we thought was transient, was not transient. Inflation rose and rose significantly. 1.2% in 2020, 4.7% and 4.7% in 2021, 8% in 2022, and it got up to as high as 9%, and then down to 4.3% in 2023. So both periods carried with them very significant challenges, and our policymakers responded to those challenges. They sometimes have been referred to as excessive, an excessive response. I love Herbert Spencer, was an economist, said the ultimate result of shielding man from the effects of his folly or misfortune is to people the world with fools. In other words, the Federal Reserve and the federal government in Washington came to the rescue in 2020-21, and what Spencer would say is that was foolish. But what Kindleberger said, and I think this is right, too little and too late is one of the saddest phrases in the lexicon, not only of central banking, but of all human activity. Too little, too late. The Federal Reserve responded. The Federal Reserve responded in 2020 and 21. I might add, for those of you that are political, you're not going to like me for saying this, but I'm going to say it. Most of the stimulus from the government that led to inflation came from Trump, did not come from Biden. Keep that in mind. Most of it was the CARES Act in 2020, not in 2021. I know what you heard during the campaign, that it was all Biden, and he's the one that stimulated or created the high rates of inflation. Not true. At any rate, we could talk about that if you want to at some point in time. But the point being, the Federal Reserve increased its holdings of financial assets by $4.5 trillion. And it did that by going to banks, insurance companies, hedge funds, and believe it or not, individuals, and buying treasury securities, treasuries and mortgage-backed securities, buying, and guess what? They paid for them. And when they paid for them, that increased the money supply. In addition, the federal government in Washington increased its spending by $2.1 trillion. And as a result of that, the money supply, as measured by M2, increased by $6.2 trillion. The money supply increased by $6.2 trillion, 28%. The highest number we ever saw in our history was 13%, 28%. And as you might guess, predictably, that led to much higher inflation in 2022 and 2023. We went from 1.2% inflation in 2020, 4.7 in 21, and 8% in 2022. We found out or learned, we learned that inflation wasn't, after all, transient. That was followed, of course, by 2022 and 2023. And then faced with inflation, you can just guess what happened. The Federal Reserve, instead of buying treasuries and mortgage-backed securities from banks, et cetera, and paying for them, reduced their holdings of mortgage-backed securities, treasuries and mortgage-backed securities, and they did that by taking those very same treasuries and mortgage-backed securities back to the banks, back to the insurance companies, back to the hedge funds, back to the individuals. They gave them the treasuries and they made them pay for the treasuries, and predictably that led to a decline of $1.1 trillion in the money supply. So first we had an increase in the money supply, which led to higher inflation. Then we had a reduction, active reduction by the Federal Reserve and the federal government in both holdings of financial assets by the Federal Reserve as well as spending by the federal government, which led to a decline in M2 and a decline in inflation. All very predictable. Here's the big question. The big question was, how did they pull this off? And the big question is, look, it led to a decline in the rate of inflation, and we got down to 8% down to 4.3. It's now going to get down to below 3% in 2024. How did they pull that off without creating a recession? How did they have the money supply decline, and we still had fairly strong or robust consumer spending? How did they pull that off? And here's where my friend Walter Goldstein once again came in to tell me what the story was. And he used to look at me and he used to say, Hugh, look, I understand that there wasn't much growth in the money supply. In fact, the money supply went from that plus 28% down to contracting and declining. And I said, Walter, how can you explain this? We got a contracting money supply and rising consumer spending. And he used to look at me, it's velocity, Johnson, it's velocity. I said, okay, Walter, what do you mean? And he said, look, when the inflation expectations, worries, are very high, that's also a time when people, when they get their paychecks, they go out and they spend it right away because they think prices are going to be much higher the next week, which they were. And so a legitimate response. And so as a result, consumer spending continued to be fairly robust. Robust despite the fact that we had a contraction in the money supply, but the turnover of the money supply was extremely high. Everybody get that? Everybody with me on this? Okay. There's what happened to velocity. There's a chart of velocity. That's the turnover of money. And you can see what happened to the turnover of money during this period of time. Even though there wasn't much money, the turnover was very significant or active. Okay, what's happening right now? I'm just going to add this one just because I love it, and this is liquidity. Even though money supply is now actually expanding just a little, I can't get it, but anyway, money supply, you can see that liquidity conditions are improving, which really just means simply that the money supply is increasing just a little bit now because the Federal Reserve is taking its foot off the brake, right now. And they're taking a foot off the brake, a little bit of money supply growth, and liquidity conditions are not positive yet, but they're pretty close to turning positive. I'm going to say something which is going to be a little bit technical. I'm going to just say it anyway and hope you get it. And that is liquidity conditions are close to being positive now, which means the growth rate of liquidity is very close to that point at which there's enough money being created to drive both the economy and the financial markets. When liquidity conditions are positive, we're close. When liquidity conditions are positive, the average annualized rate of return for the stock market is 16.2%. When liquidity conditions are negative, the average annual return is 2%. So you can see liquidity conditions matter, and that's why I'm somewhat encouraged by this number. The bottom line is you've got the financial markets are sending a message which is positive, and you're also getting, if you look carefully at all of this stuff on monetary and economic variables, it looks on balance. It looks on balance positive, particularly because the economy is indeed expanding, despite the fact that the Federal Reserve went through this long period of restraint. Now, this is going to sound a little inconsistent with what I'm about to say, but I'm going to say it anyway. Things actually, in response to the Federal Reserve's increase in interest rates, in response to the reduction in spending by the federal government, things are actually right now slowing. The average month-to-month increase in employment is, if you look at it on a 3-month moving average, don't have to be technical, 3-month moving average, if you look at it, it's coming down. Employment growth, the growth rate of employment is slowing. The growth of personal income spending, personal income is slowing. The growth rate of disposable income is slowing. The savings rate is coming down. The level of debt that is owned by individuals is coming down as they're trying to reduce that debt, struggling to reduce that debt because they're using a lot of the debt for the borrowing in order to finance spending. And consumer spending, despite what you see here, even though it's somewhat robust, is actually slowing down or coming down. So that gets us to what is our forecast for what lies ahead and what are the implications of the Trump policies on this forecast. I'm going to try to slop my way through this because this is not easy, but I'm going to try. Okay. Yes. No, well, that's a good question. Uh, the Fed has shown considerable restraint. For a long time, they raised rates until they got raised rates up to close to the 5% on the federal funds rate. Now, of course, they're going the other direction. They're showing less restraint. In other words, they're starting to reduce short-term interest. I'm going to get to that in just a minute. But you're absolutely right. They're still showing restraint because the federal funds rate is still fairly high. They cut it in September by 50 basis points. They cut it 25 basis points in November. And my guess is, and it's a guess, and I'm going to hesitate on this one, is another 25 basis points in December and one time each quarter in 2025. With me? That's my, and I'm going to call it a guess because I've looked. It's okay. It's okay. Believe me, I've been wrong more than once. I wish I had a nickel for every time. No, I can't. You know, at any rate. Okay. What you can see is it's Hugh Johnson economics, and Hugh Johnson, that's me, forecast for the economy is that the U.S. economy is in the process of slowing. It's going to slow in 2025 and 26. It's going to slow from the 2.7% pace of 2024 to 2.1% in 2025 and 2.2% in 2026. This is the predictable outcome of something, and I might say the average annual growth rate of the economy from 1980 through 2019, a good reference point, was 2.7%, so it's going to slow from those numbers. Why is it slowing from, do I have a little more time? Okay, why is it slowing from that pace? The reason is very simply this. Look at this chart. Growth rate of the population has slowed. The growth rate of participation rate, which means the percentage of the population that are either employed or actively looking for jobs, has slowed, is less. As a result of that, the growth rate of the labor force has slowed. As a result of that, the growth rate of employment has slowed. And interestingly enough, the growth, the productivity of that labor force is also lower. So it's just very logical that we're going from growth rates for the economy of 2.7 and higher to growth rates for the economy that are lower, which is why you get the forecast that I gave you for 2025 and 26. Now the question is, what will be the impact on the growth rate of employment, that very important variable that will determine the outcome for the U.S. economy from the Trump administration immigration plans? I'm going to show my stripes here in a second, I'm afraid. But non-farm payroll employment has increased by, on average, 1.095 million, and immigration, lawful immigration, is increased by an average 923,000. 923,000 is a big number when you're only increasing employment each year by a little over a million. What's going to be the implications of immigration policy, which either includes deportation or doesn't even include deportation? It's going to include deportation, but also limits or restraints on the amount of immigration that occurs at the southern border or anywhere. I don't know what the answer is, but I can tell you what a pretty good calculation by Goldman Sachs is it'll probably reduce the number, the immigration number from that 900+ thousand down to about 750,000. And then ask yourself the question, therefore, what is going to be the implication of the immigration policy on the outcome for the economy, which I expect to slow in 2025 and 26. And I'm not going to answer that question because it's just too obvious. It's going to have, obviously, a considerable impact on the outcome for the economy. The next thing, of course, is employment. The consensus forecast is that employment will slow from the basically the 182,000 per year average monthly increase in 24 to 125,000 in 2025 and 150,000 in 2026. The unemployment rate will edge a little bit higher as well. And again, this is the baseline forecast. This does not include the integrating of the Trump immigration policy into this forecast. So the forecast is things are slowing down, and they're going to continue to slow down. This is a little bit tricky. The question is about inflation. I'm going to skip a little bit here. Inflation is likely to continue. It has been declining. And I'm going to get to your point. It has been declining. The last numbers, and I apologize, Lou. I know you asked me about that inflation number.
Yep.
I gave you the wrong answer. It was not a particularly good number. I looked carefully at it afterwards. Yeah, wasn't particularly good. So the point is, but on a continuous basis, inflation has been coming down. The Federal Reserve's been doing a really good job. But there are months, such as the month of October, and we just saw the numbers this week, where inflation on a year-over-year basis does not go down. It actually ticked up a little bit. And that's why you saw Powell the other day saying we didn't need to be in a hurry, and which leads me to believe that maybe they won't reduce in December. It's still up in the air, but you can stay with my forecast. That's okay. At any rate, so the point is inflation is continuing to decline. The economy is slowing down. I think the economy will continue to slow down, and I think it'll slow down in particular when you look at the outcome of the numbers for the fourth quarter and the first quarter and the second quarter of 2025. So the Federal Reserve will be faced with, I hope, continuous declines in the rate of inflation and an economy which is slowing, which might put a little bit of urgency on the Federal Reserve to continue to reduce short-term interest rates, which is why I come up with they will reduce rates in December and one time per quarter as we move through 2025. Then there's the question of tariffs. As you know, there's a number of tariffs that are being proposed by the Trump administration to include a 10% to 20% baseline tariff, 60% on China, as well as a number of tariffs, even as much as 500% on specific products from specific countries, such as automobiles from Mexico. These are fairly stiff tariffs. The most common reaction is this is going to lead, the increase in tariffs is going to increase product prices. Maybe not. And let me tell you why not. Because in 2018 and 2019, we had a trade war with China. What China did in response to the trade war, the increase in tariffs, think about this. They offset the increase in tariffs with price reductions. And as a result, the price tag to the U.S. consumers or producers that were buying the products was unchanged. And they did that to try to preserve market share. And guess what happened? Prices were the same, the Chinese preserved market share, and not only did that, with lower prices, went to other countries in the world and recovered a lot of the lost product sales to the U.S. If somebody were to tell you who won that war and who lost that war, it's really clear from the numbers that China won and the U.S. lost. And China won, if you take a look at the amount of sales by China, imports from China into the U.S., between 2017 and 2020, a decline of 0.4%. China won. And so I say the tariffs represent or mean that we'll be looking at higher prices. My answer to that question is maybe, but I doubt it. The Chinese are really good competitors. I just don't think it will work. Although I will say something I said to somebody last night. Robert Lighthizer, who was the trade representative at the Trump administration during those trade wars, is really smart and really knows what he's doing. So I wouldn't count anything out quite yet. Next thing, Federal Reserve policy. Again, I think Federal Reserve policy is going to continue to be reduced in response to a slowdown or continuous decline in the rate of inflation and slowdown in the economy. And the Federal Reserve, feeling that sense of urgency, will reduce short-term interest rates, I hope. And in addition to that, longer-term interest rates, currently up about 4%, 4.3%, are likely to come down. In addition to that, stock prices are likely to go up through 2025 and 26. let me say something. What this says is the stock market currently, and this is important, stock market is currently 6.5%, as I do the numbers, everybody does them differently, 6.5% overvalued, and so an 6 to 8% correction in stock prices would be good news because it would take stocks down to levels which are more attractive or make more sense from a valuation point of view. Remember, I say they're overvalued. Remember what I said about speculation, leverage, widespread optimism, as well as overvaluation. And we have widespread optimism right now, and we also have overvaluation with the S&P 500. So in my judgment, even though I think prospects are good, not for 2025, but as we get through 2026, 12.5% between now and the end of 2026, you're going to have to be really patient in 2025. 2025, we're faced with something that looks a little bit speculative, a little bit too high. I wouldn't really worry about it. Keep in mind my favorite expression that has guided me in my investments somewhat all my life, and that is, think about this. Here's what you should write down. It's time, not timing, that's the secret to success as an investor. Okay. I have just a minute or two that I'm allowed to say something about the tax cuts. The biggest item on the agenda, in my view, for the Trump administration is they want to extend the tax reductions from 2017 when they sunset in 2025. The question is, if they do extend those tax cuts, will that have any impact on the deficits that Lou was talking about? And the answer to that question is, we got from the Congressional Budget Office, is it will increase the deficit by $3 trillion over 10 years, and it'll increase the debt service payments, interest payments by the federal government by $467 billion over that same time. And you asked the question, legitimate question, okay, we're going to have to finance that $3 trillion. That's right. How are we going to finance that $3 trillion? Well, take a look at who's been the buyers of U.S. Treasuries. And if you look at who's been the buyers, you will see in number 2 place, foreign investors. Those very same foreign investors that are going to be faced with tariffs. Now, what's that going to do for their inclination to continue to finance the federal budget deficit when they're facing significant tariffs? And the answer is they probably won't. Well, then what will that do? They'll have to hike interest rates in order to attract their capital from other parts of the world. What will that do to the U.S. economy? I know I almost don't have to answer these. I'm going to finish up by just one comment. I want you to first of all read this from Kindleberger. This is from Charlie Kindleberger, as I mentioned, who is probably the foremost economic historian of our lives. He was a dear friend of mine. And incidentally, this is austere stuff, but he was a jovial, wonderful, humorous person. But read this. Read it. And think about it. And here's the other thing that came in. And I don't want to end up on too dour a note, and I apologize, Lou, for ending up on a dour note, but I want to end up with something that was in the if I can find it, in the Economist magazine this week. And that's this, and I'll just read it to you. Here you go. Okay, this is my point. Before the fight against fascism convinced FDR that it was in the country's interest to help bring order and prosperity to the world, The country was think about this. The country was hostile towards immigration, scornful of trade, and skeptical of foreign entanglements. That sound familiar? In the 1920s and 30s, that led to dark times. It could do so again.